Okay, thank you everybody for joining the call today. I'm Lou Kerner, Managing Partner of CryptoOracle, Community First VC Accelerator and Incubator. CryptoOracle's best known community initiatives are Crypto Mondays, the largest crypto meetup in the world, now in 40 cities and 20 countries, and Crypto Commons, a crypto shared workspace headquartered in New York City, with locations next month opening up in Dallas, Paris, and Berlin. Today's call is titled WTF is Ripple, and is it worth $45 billion or $37 billion as of today's price? But given Ripple's recent emergence as the second most valuable cryptocurrency, these are increasingly important questions to have good answers to, and we're fortunate to have three experts with us today to share their views on all things Ripple. We're going to start with Nicholas Goss, Chief Operating Officer of Futurism Markets, a liquidity solution for small to medium-sized issuers, leveraging blockchain to provide customized smart contracts that enable compliant trading. We'll then hear from Kevin Kelly, co-founder at Delphi Digital, an independent research boutique specializing in digital assets and distributed ledger technology. And finally, we'll hear from Cory Johnson, Chief Marketing Strategist at Ripple. We'll leave plenty of time for questions at the end from the audience. So if you have questions, you can ask them at any time via the chat box, and we'll get to as many questions as we can before the call ends at 2 p.m. EST. There will be a replay of the call posted on our Medium channel, and the slides are available for download via Zoom, and we'll also be posting them on SlideShare to be downloaded there. And with that, I'd like to turn the call over to our first speaker, Nicholas Goss, with Futurism Markets. So Nicholas, you want to take over the screen?
Yep, I will do. Thank you very much for the introduction. Let me see if I can figure out how to take over the screen quickly. Boom. Go.
There you go.
And does everybody see the presentation and hopefully not much else?
Yes.
All right, so let's get started. So thank you again very much for the introduction. I'm very excited to be on this call. Being a former securities lawyer and a nerd generally, I really savor the opportunity to discuss securities regulation with anyone. The question that I was sort of asked to prepare a short presentation on is just whether or not XRP is a security. So that everybody has some quick background on me, I was originally trained as a securities lawyer at a law firm called Latham & Watkins up here in New York. I was there for just under 3 years and then followed it up with an investment banking stint at Credit Suisse for a little over 2 years. I left that job to co-found Futurism Markets earlier this year. So again, what I'm going to be diving into is whether or not XRP is a security. I know I believe we have Cory Johnson on the line as well, so he can probably add some color later on to some of the things I'm going to highlight here. Flipping over to the executive summary. So the good news here in determining, just solely for determining whether or not XRP is a security, is that we may have an answer relatively soon. There's a pending class action suit in the Northern District of California. It's actually a consolidation of 3 class action suits, all alleging similar claims. A couple things that I want to point out here is that first and foremost, these are all private litigants. So we generally attach a lot of weight to what the SEC says, and rightfully so, considering they're the relevant regulator and rulemaker. But what is often overlooked is the role of investors themselves in regulating potential securities transactions. So when an ICO loses money, the folks who put money back into, the folks who initially put money in are going to look to get it back. And frankly, with the amounts of money that were raised at the beginning of this year in a whole variety of ICOs, class action lawyers tend to be heavily incented to find deep pockets. So why is this important? So I know that Ripple has sort of frequently stated that the determination of whether or not XRP is a security is a question for the SEC. And unfortunately, that's not really the reality. The civil suits, the judicial system are all binding precedent in the jurisdictions in which the outcome is determined. And it's also indicative of how other jurisdictions might shake out. So the latest on this case is essentially it's been removed to federal court. The next major date is February 21st, 2019, which is the case management conference. We may glean additional information there, but I think this will probably move relatively slowly. What's really important here is that because it's in federal court now, the Ninth Circuit applies something called narrow vertical commonality. I'll dive into this a bit more on the next slide. The important thing to note here is that narrow vertical commonality is an easier standard to satisfy than horizontal commonality for purposes of determining whether, in this particular case, XRP is an investment in a common enterprise and therefore an investment contract and a security. The last thing I want to talk about just as a quick summary is sort of the effect of Director Hinman's statement. I think when Director Hinman first came out with his statement regarding Ethers and Bitcoin's status as quote unquote not a security, the crypto community enthusiastically embraced the decision. I've written a bit about this, but essentially what Hinman did was apply a facts and circumstances analysis and by the way, the facts and circumstances analysis that he applied is what is most commonly applied across jurisdictions to two particular crypto projects. Now, this is a very helpful analysis ex post, simply because it gives you an idea for what the SEC thinks and how they might view projects moving forward. But as a company trying to operate in a world of regulatory uncertainty, these sorts of analyses aren't particularly helpful. This question of, are we sufficiently decentralized or are we not? Are we still a third-party promoter, or have the information asymmetries fallen away that would give rise to the need for securities regulation? I've found that what companies much prefer are safe harbors where they can proactively check the box and satisfy requirements to, as opposed to a number of unknown and weighted factual inquiries. For example, and I'm just going to sort of do this off the top of my head, what we can do is run through a couple of Hinman's prongs. And what we should do is keep in mind, what we know about Ripple and its relationship to XRP as we run through these. So one, is there a person or group that has sponsored and promoted the creation and sale of the digital asset, the efforts of whom play a significant role in the development and maintenance of the asset and its potential increase in value? Two, has this person or group retained a stake or other interest in the digital asset such that it would be motivated to expend efforts to cause an increase in the value of the digital asset? Three, has the promoter raised an amount of funds in excess of what may be needed to establish a functional network? And if so, has it indicated how those funds may be used to support the value of the tokens or to increase the value of the enterprise? Four, and I think this one's very important, are purchasers quote unquote investing? That is, are they seeking a return? As I was saying earlier, the sufficiently decentralized question is very specific to an individual project. And so it will be dependent on a particular ICO and where the network stands at the point of time that they actually raise funds. Here, it feels like the SEC's weighting of those facts and circumstances come out a particular way. That being said, the SEC's weighting isn't really what's binding. It's a legal standard that's binding, and that's determined by a judge in a court. So to that, I'm going to move to my next slide, which is sort of an outline of the legal standard. By now, I'm sure everybody's fairly sick of hearing about the Howey test. But one more time, something is a security where, one, there's an investment of money, two, in a common enterprise, three, with the expectation of profits solely from the efforts of a third party. That third prong is actually often divided into two, where you'd say three, with the expectation of profits, four, solely from the efforts of a third party, but I've consolidated them here. So there are a couple of things that I would just want to address before we sort of apply this legal standard to Ripple and XRP. The first one is that money is not actually required in the first prong. It's really more of the receipt of something of value. So this question came up in securities law back in the early 2000s with all these tech companies who were trying to do free stock giveaways. When their share price sunk and they were sued for rescission, essentially what they argued was, hey, Howey says that you need an investment of money. Nobody invested any money. The courts have sort of read the word money out of this standard. And the reason for that is essentially to say, listen, what you're receiving is value. It doesn't have to be money. It can be a number of things, including just publicity for your particular network. Obviously, in the crypto community, the area where this becomes particularly relevant is in this idea of airdrops, where folks have argued that just because they're sort of airdropping tokens on folks, they aren't actually investing any money, and therefore it falls outside the purview of securities law. That question, I should say, has been asked and answered, and it's been largely dismissed. The second consideration that I want to chat about quickly is, what constitutes the quote unquote common enterprise. So this goes back to what I was talking about on the last slide, right? The most common analysis that's done across most jurisdictions is this concept of horizontal commonality. The easiest way to understand this is just think of your traditional investment, right? This is where investors pool money or assets to fund a project, and any capital appreciation or payouts from that project are distributed pro rata to the folks who bought in. This is the most difficult standard to satisfy, and it's also the most widely adopted across circuits. A brief note on the circuit split. So as people know, there are a bunch of circuit courts that cover various states. Above them sits the Supreme Court, right? The Supreme Court has never opined on this horizontal commonality versus vertical commonality. Therefore, the individual jurisdictions have developed their own tests to determine what constitutes a quote unquote common enterprise. Vertical commonality, by comparison, is a bit easier to satisfy because all that it requires is that an investor's profit or loss be subject to the efforts of the promoter putting together the deal. Narrow versus broad, this is a separate circuit court split, but essentially the question is just whether or not the promoter's profits are tied to that of investors. Really what's important here is just to note that the Ninth Circuit applies both horizontal commonality and narrow vertical commonality, which essentially means that all that a plaintiff would need to show is that their profit is tied to that of the promoter. Next, I want to talk about expectations mattering. So this sort of goes to what Hinman noted in his last bullet point. Essentially, are folks investing in this with a look to turn a profit? I don't know how many of you saw the Blockvest injunction denial yesterday, but as is common in the crypto community, there were these amazing headlines about how federal judge slaps down SEC plan for injunction, labels a particular token not to be a security. Essentially, what was really going on there was that Blockvest made headlines because the injunction was denied, but it was denied because there was a question of fact as to whether the tokens were securities. The analysis in that particular example turned on the expectation of the people actually participating in the ecosystem. Blockvest made the claim that, hey, listen, our network wasn't functional. We had a whole bunch of people come in who were serving solely as testers to make sure that this was working appropriately. And because they were testers, they weren't actually investing money, right? This was just small fries essentially that were used to make sure that this ecosystem was actually working appropriately. I actually find that to be a fairly compelling argument. What's interesting is when you compare that to something like a Ponzi scheme, right? Where expectation doesn't mean expected value. A Ponzi scheme could have a negative expected value for everybody involved. There are certain people who win, others who lose. I think my favorite example of this is sort of FOMO 3D, which was the crypto game that was going around a couple months ago. Essentially, the way that functioned was, as folks funded in, people who held a token earlier were paid out small portions, and a portion was given to a pot. That pot went to whoever held the token when a timer ran out. So with something like that, right, you can have an expectation that, hey, I'm going to do this for fun. I'm probably going to lose money. Maybe I'll win something huge, and that will still be considered an investment. Last but not least, I want to talk about the word solely. Solely from the efforts of a third party shouldn't be read literally. Howey came out of this Orange Grove case where there was a contract for the sale of land, coupled with an agreement to work the land and sort of pool profits and distribute them out to all the various landowners. If you read solely literally, meaning that the third party promoter is the only one who is responsible for the success or failure of the enterprise, then a very easy way to avoid securities regulation would just be to say, okay, I'm going to go and work the land for one day. I've contributed something to this project, therefore this is not solely from the efforts of a third party. Essentially what solely means, the leading case here is a case called Glenn W. Kerner. It just means that the promoter exerts these significant efforts that affect the failure or success of an enterprise. So with that background, I'm going to go through and I'm going to apply this test to Ripple and XRP. In diving into this over the last couple of days, I think what I saw on the Ripple website was essentially an entire page dedicated to saying, Ripple is different from XRP. Ripple is a technology company. XRP is a digital asset that acts as a medium of exchange for currencies. There were 200 billion of these things created at inception, and they're completely separate from us, Ripple, the technology company. So I think that that's an important distinction to make, but the important point to note here for securities law is just, well, regardless of having sort of a separate digital asset, are you guys the promoter about whom investors would require certain disclosures in order to ensure that they are operating in a fully disclosed and fair market? So what I've noticed is, and I'm going to go through the Howey prongs here, 1 through 4. Prong 1, investment of money. Ripple sells XRP every quarter, 400 million 2018 year to date, I think, according to their filings. According to their presentations available online. Purchases may be done using fiat or crypto, regardless of people's takes on investment of money versus receipt of value. I think it's fairly clear that this is an investment of money and a transfer of value from a group of individuals to Ripple. Next question, is it an investment in a common enterprise? So now, once again, keep in mind that narrow vertical commonality and horizontal commonality are what are applied in the Ninth Circuit. that means that there's a much easier standard to pass than if, for example, you're in the Second Circuit. The question is simply whether the investor's profits or losses are, quote, interwoven with and dependent upon the efforts and success of the promoter. From what I've seen, Ripple, and it's a benefit to them, has gone out and said, listen, our interests and those of the XRP investors are aligned. We both want the price to go up. We both want it to go through the roof. So it seems to me like it feels like this will pass the narrow vertical commonality test, maybe the horizontal commonality test, but again, that first one is all that's required for the Ninth Circuit. Next one is this question of, expectation of profits versus a commodity for consumption. All right, the two things to note here is that an expectation of profits can be in the form of capital appreciation or participation in earnings. In my mind, what I see here is that XRP is supposed to be used by banks and payment providers to help facilitate payments. It's supposed to reduce transaction costs. Yet XRP is being purchased by retail investors. Why do those retail investors purchase it? Is it because they plan on using XRP, or is it because they're sort of expecting a profit as Ripple continues to develop their network and get increased adoption of their technology? Last but not least, and I know that I'm running out of time here, I think I only have 10 minutes, is solely from the efforts of a third party versus sufficiently decentralized. From what I understand, Ripple promotes XRP and updates the XRP ledger to effectuate more efficient transaction. The vast majority of Ripple is controlled by XRP. I have in here, how many nodes. This is a question of sort of validators. How many people out there that aren't under the control of Ripple have the ability to sort of verify transactions that are done on the network. My understanding is that this is heavily concentrated, heavily consolidated, and therefore it's difficult to make the effort that there is not a third party promoter here. Finally, I'll go into some of the counter arguments. I think the first one is that Ripple could disappear and XRP will continue to exist. That's interesting, but I also think it sort of sidesteps the actual question here. The question is, whether or not XRP is an investment contract that has a third-party promoter who possesses asymmetrical information that would be important to investors. I think in order for this argument to work, you would have to say Ripple could disappear and XRP will not be impacted by Ripple's disappearing. And I don't think that's the case. I think that most people invest in XRP. They buy XRP anticipating that Ripple will succeed. They hear about the partnerships with the banks and they think, okay, this is going to be a real medium of exchange for these guys. The next one is XRP offers utility, not equity. This is a variant of an argument that, hey, the Securities Act lists, equity notes, promissory notes, et cetera, et cetera. Essentially, just because it's not equity, because there's no right to a dividend payment, doesn't mean that it's not a security. The Howey test is geared towards determining whether or not something is an investment contract and therefore security. And so that analysis we just did on this last slide is sort of picks up the argument here. The last one that I heard is, FinCEN signed an agreement. And because FinCEN signed an agreement, they, bounded the U.S. government to an interpretation that XRP is not a security. This one's sort of nonsensical on its face. FinCEN isn't responsible for determining whether or not something's a security. They stay within their own purview, and the determination of whether or not something is security will be, assuming a fully defended litigation, a judicially made determination. So just to conclude quickly, in my mind, it is rather difficult to argue that XRP doesn't constitute an investment contract. I think what Ripple does have going for it is that regulators have largely grandfathered in existing players. They focused on bad actors, but it's important to note that investors have different rights. Again, luckily, I'll have the opportunity to be proven wrong or correct rather quickly. There's this pending class action in California that should help shed light on how courts may think about this moving forward. So I'll stop there. And Lou, I don't know if you want to pass it off to the next panelist.
Yeah, thanks a lot for those comments, Nick. Very insightful, and we'll have, again, time for questions at the end from the audience. And with that, I'm going to turn it over to Kevin Kelly. Kevin, you want to take the screen?
Yes, sir.
Okay, now we're seeing.
There we go. Great. So I'm going to take you through Ripple, and I feel like I should talk about some of the things Nick talked about as well. It was both thoughtful and with some crucial errors that we should address. But let me talk about Ripple just a little bit. So the company was founded in 2012. We've got 240 employees. We're actually pretty close to 300 employees, and offices all around the world: San Francisco, London, Mumbai, Singapore, Sydney, New York, Luxembourg, Tokyo. And like I said, we're close. I mean, geez, when I started this job, not even a year ago, but about 150 employees. We're pretty close to 300 right now. And we're focused on a singular business use case. There are so many things that can happen in the world of blockchain. There are so many things that can be done with all sorts of digital assets, but we are really focused on cross-border payments and using blockchain-based solutions to facilitate blockchain cross-border payments. We've got over 100 production deals with banks and financial institutions, remittance companies, large and small, everyone from Santander to CIMB to Cambridge FX to TransferGo and others. American Express, among those, SBI in Japan as well. And it's not just banks, but remittance companies. You got to think of those thousands of businesses out there that are helping people move money across borders. Right now, the global payment system is just broken. You know, in a world where we can send text messages and emails in seconds across the world.
Cory?
Yeah.
Cory, I'm sorry, and can you describe exactly what is meant by production contract? Yeah,
so these are paying customers who are using our solutions in business right now. They're paying us for the service. They're not pilots, they're not tests, but they're actually in production with us.
Okay, thanks.
So the world of payments is really broken. It is not digital in the way that we expect data to be digital. It's not digital in the way that we expect even goods to be kind of global. It's slow. It takes 3 to 5 days. There's over $10 trillion trapped in sort of pre-funding and Nostra Vostra accounts. You got companies like, you know, I often make the argument that Amazon.com, right, has $1 billion parked. The most capital efficient company in the history of the world has $1 billion parked in accounts waiting to make a payroll somewhere or to pay a vendor because the payment system is so slow and unreliable. There's over 6%, a 600 basis point failure rate of SWIFT transactions. So, sorry, let me get back here. So there's a lot of, in terms of reliability, a lot that needs to be desired. We imagine a world using RippleNet, and indeed our software solutions are helping on-demand, real-time, low-cost and inexpensive, no failures because the messaging system is instantaneous. You can see what's happening as it happens, and an elegant experience for the users at these financial institutions. Here we go. So what we require and sort of imagine what we're doing here is settlement predictability, a consistent cost of the transaction. So believe it or not, the way financial institutions move money right now in the correspondent banking system, they don't even know what it's going to cost to get the payment to the other end. So they charge their customers a lot of money hoping that there'll be something left over when they're done, but they don't even know what each step of the process is going to cost them or how long it's going to take. We want to have very high throughput. You have to be able to do a lot of transactions, and we want to have a scalable energy usage, which we don't see with other mining solutions, for example. Now, when you compare across the world of digital assets, you can see that they're very different. And I think what we've seen in the trading in the last 90 days, where XRP's value has actually increased and everything else has collapsed, you really do see some differentiation in the marketplace because indeed, these digital assets are different. The cost per transaction for XRP is significantly lower than Bitcoin Cash or Litecoin or Ether or certainly Bitcoin, which is much more expensive. The transaction speed is enormously faster because XRP is really focused solely on the transmutation of value, that a transaction can happen in 3 seconds. And indeed, there are so many transactions that there can be 1,500 transactions a second. Bitcoin can only handle about 32, Ether about 16, and so on. And there's also a predictability in that. So among our software products is the one that seems to get the most attention. Yeah, go ahead.
Cory?
Yes, sir.
Just in terms of when you were talking about the throughput, is that a max number, and are you sharing kind of what you're averaging in terms of throughput?
That's the average as of May. And it's important not just because the potential is there to do a quick transaction. You know, a Bitcoin transaction can happen quickly, but they happen very at a very uneven basis. You don't know if the transaction is going to take 20 minutes or a few seconds. With XRP, you know the transaction is going to happen in just a few seconds, and you know that there are many transactions that can happen at once. And that's happening right now. Does that answer your question, Lou?
Yeah, that was great. Thanks.
I can see you nodding. I can feel the presence of your nodding. Let us move on here. XRapid. XRapid is a way to provide liquidity to the markets and using XRP. So in a transaction that's going, say, from a U.S. Financial institution to Mexico, for example. What happens is the transaction is routed using XRapid to an exchange in the U.S., transfers from, say, U.S. dollar to XRP. XRP zips across the Ripple net, shows up in an exchange in Mexico, goes XRP to peso, and shows up in the financial institution. Because this is happening so quickly, there's no need for the financial institution to have a Nostro account with the cash waiting, say, in the Mexican bank or the Mexican company keeping cash in the U.S. bank, which is the state of the art before Ripple. Because the transaction happens in just a few seconds, the whole transaction can happen in just a few minutes. The exchange happening from fiat to XRP and XRP to fiat, each of those takes just a few seconds. There is no need to provide the liquidity in advance, and thereby reducing and not eliminating Nostro accounts. Now, Nick brought up some points about centralization with some really important factual errors that I want to correct, and thankfully I have this slide to do so. He talked about the nodes in the network. There are over 150 nodes, validators on the Ripple network. My company controls just 5 of them. That's about 7%. The number of nodes has actually gone up since we made this slide. It's I think 4.7% of the nodes of the validators in the network are controlled by Ripple. Most of them are external to the company. A vast majority, 95%, call it, are outside of our company, and I think that it's proof that this is decentralized. There we go. There's my colleague Tom saying we're on 7 of them, as you can all see. So again, 7 out of 150 is about 5%, and it's by no means centralized at our company. So that's a mistake that I've heard before. Nick's not the only one to get it wrong, but it's wrong. And I also think that this notion of what is centralized and what isn't actually changes over time. If you look at the mining of Bitcoin and Ether, 80% of Bitcoin mining is taking place in China. 51% of it is by just 3 miners in China. I think you can make a reasonable argument to say that China has centralized the ability to control the Bitcoin network in ways that was not even true 4 or 5 years ago, but is true today. XRP, as more and more validators have been added to the network outside of our company, the Ripple's control over the XRP network, if we ever had any, is sort of demonstrably doesn't exist anymore, and is more decentralized with every single validator added to the network.
Cory, can you talk about who the validators are and the concentration among the validators?
Yeah, I don't know about any concentration among validators, but they're universities, they're Ripple customers, they're supporters of the XRP network. There are other companies that are using XRP, there's basically anyone who's trying to support the XRP ecosystem is running validators. And so there's other companies using XRP. Those are universities and some of the financial institutions who are using Ripple's products or other things in XRP. There are companies like Coil. So you've heard of this company called Facebook, Lou? I think you're familiar with it. And others are familiar with it too. Yeah, I've used it. So Facebook makes money by pushing ads at you and taking your private information and monetizing that to great dismay lately. I say this, I'm actually a Facebook shareholder lately, and so I'm hoping the best for them and Instagram and everything else. But I think that there's a company called Coil which uses XRP to essentially pay out tiny amounts of money to sites like Wikipedia to let the users keep their information private, but allow these media sites on the web to get paid. It's a very fascinating use case, and they're using XRP to do that. So those are the kinds of companies that are using XRP. Omni, another company, XRP Tipbot, where people are paying each other, sending tips to each other, sending money to each other on Twitter using the XRP Tipbot. And there are lots of companies that are using XRP and starting to use XRP to develop their businesses. Ripple's probably just further along than most. And I think it's interesting from a technological standpoint that Bitcoin can do so many things. Ether very focused on smart contracts. XRP as a technology is really focused on value and only value, and so as a result works so much faster. So in terms of what's different between Ripple, I thought Nick's presentation was very interesting, but some of the as I pointed out the thing about the validators being just way off the mark. I also think the notion that the SEC doesn't determine what's a security is, I'm sure the SEC would find it interesting that Nick's notion that they don't control it, or that the words in the Howey test shouldn't be taken literally. That's you can read into that as much as you want, but I think maybe they should be taken literally, and probably are taken literally and have been in the past. But I think that fundamentally, XRP, we use XRP for some of our software solutions because we think it's the best way to move value across a network. And but you can buy all the XRP in the world and it won't get any control or right to the profits from our company. And our company could fail massively, which would be a bad day for the Johnson family, but XRP will continue to exist. And the validators on the network will continue to exist. The 95% of the validators that are out there now that are not part of Ripple will continue to make XRP work. And some other companies may have great success, even if Ripple screws up this great opportunity. And XRP will have whatever value it's going to have, regardless of the results of the experiment of Ripple Labs.
So terrific.
You've got to. Yeah.
Yeah. So we'll we'll have questions at the end. But Kevin, you want to take back the screen, and hopefully you've dialed in and we can hear you perfectly now.
Yes, sir, I will. All right, can you guys hear me?
Yes.
Fantastic. All right, let me pull this presentation up. Sorry about that again.
Yeah, we'll be able to edit it out on the replay.
Perfect. All right, can you see the presentation now too?
Yes.
Fantastic. All right, so thanks everyone again for having us on. Appreciate hearing the comments from Nick and Cory already. Again, sorry about kind of got in the hole here. But my name is Kevin Kelly. I'm a co-founder of Delphi Digital. We're basically an independent research and consulting firm here based in New York. And so what we wanted to do today is kind of give an overview of how we start to value or start to look at something like XRP. I think a lot of really good points were made in terms of kind of separating church and state between, Ripple, the company themselves, and XRP. And so what we really want to do is, take an objective view of looking at XRP, using a lot of the things that Ripple and the insights their company has given, which have been extremely helpful into, starting to develop these different models of how to view this from an investor standpoint. But again, it is very important to stress that this is really not a valuation of, Ripple, the company itself, just really what we think, the longer term, use case and value could be potentially for the XRP network. So with that being said, quick disclaimer, nothing in this presentation is taken as investment advice. Every person should do their own due diligence for making any investment decision. Commentary simply reflects the opinion of our analysts. None of our analysts hold XRP. And as I mentioned, we're really just trying to objectively evaluate, and start to put a framework around how to value something like XRP. It's very, very early stages in this market, as we all know. So, this should serve maybe as a proxy or a starting point to kind of build out a more full valuation or attempt to build out a full valuation of what you think XRP could be worth long term. So what we wanted to do is we want to start off with just kind of getting the consensus of what's in the market, right? The bull versus the bear argument. And so on the bull side of things, transacting XRP offers faster settlement times, larger throughput capacity than alternative cryptocurrencies. Cory definitely hit on that in his presentation. Ripple Labs continues to sign important partnerships with banks and other financial institutions. Interbank settlements are definitely one of the areas that we think are ripe for disruption. XRP is already being used to facilitate some of these transactions. And it has an a highly engaged community, right? So it's very strong following on social media, very vocal following on social media. And this is actually one of the more polarized communities that we've seen, right? It seems like there's no real kind of neutral ground. You're either a bull or a bear on XRP. The bear narratives, kind of the consensus bear narratives, centralization risk, given the majority of XRP is currently owned by Ripple, has been touched on. Efforts being made to onboard more external validators, but Ripple still holds significant influence. Really just in the oversight of XRP in general. Volatility of XRP, so there's a potential risk for banks, ultimately could hinder its long-term adoption. But we think as this market matures, the volatility shouldn't be an issue long-term. The big one, and really what we're going to hit on a lot, is XRP is not used in all transactions, facilitated by Ripple's products, and just based on the way in which, so as you can see here, Ripple products, XKerner, XRapid, XVIA, great on a lot of these. Those require XRP when we're looking at XRapid. That's really what XRP's kind of use case is in the Ripple ecosystem. And so what we kind of consider as a double-edged sword is the transaction speed and the speed at which you can actually transact with XRP, as it was touched upon, 1,500 transactions per second compared to something like an Ether or Bitcoin. But we think actually the benefits of using Ripple as a product itself and as a products that Ripple offers, there's going to be a double-edged sword, because we think as the adoption of XRP continues to grow, again, at these already pretty impressive transaction speeds, the velocity is likely to increase as well, right? And so you wouldn't need necessarily as many, let's say, XRPs at certain prices to actually support the network transaction value. So we'll get into the model in a second, but that's kind of our big takeaway. So a few of the key assumptions that we use, I mean, we really approached it with a more of a utility token framework. Utility tokens obviously get a bad rap, but the reason why we wanted to take this typical kind of approach to it is, as was alluded to earlier, there is a big difference between Ripple the company and XRP. By owning XRP, you're not entitled, similar to holding stock in Apple, you're not entitled to cash flows or the profitability of Ripple the company itself. So we're really trying to value the network long-term potential of the XRP network, and we do that by calculating a long-term potential network value using the incremental value add that XRP can offer over other Ripple products. So this is kind of the current state of how we understand XRP being used. There's a number of, and it was exciting to hear Cory's comments on this, a number of different initiatives that Ripple's undertaking that could again change the fundamental outlook for this. But what we really want to do is say, okay, if we're trying to value what the XRP network could be worth, it's really going to be that incremental value add on top of using other Ripple products that's really going to drive that value. So a few key kind of assumptions, and I'll walk through these when I go over the model really quickly. I'll try to rip through. Total cross-border payments. So we used the McKinsey report from 2015, but we're just using this as a base case. So there's a number of different longer-term use cases for XRP, but this is really just to kind of lay the framework for how you can start thinking about trying to value these types of crypto assets. So if we say 155 trillion roughly in 2018, global cross-border payments, if we grow that at 4% annually, just based on the assumptions that were used in this report, reaches about 230 trillion in 2018. You'll see that on the next slide when I show the model. We also forecast out Ripple's market share just based on a standard S-curve, so just an S-curve to model adoption. We also do that for XRP's velocity, as you can see on the far right, and that's going to be really, can't harp on that enough, that's really kind of the key driving force behind what our valuation model ends up coming out to. And we also look at the incremental benefit using XRP, as I mentioned. So by using XRP, banks can save right now around 2 basis points per transaction over just using other Ripple products. That spread is expected to increase, and we show that as well. But again, just to kind of lay the groundwork for how we started to look at this and tried to narrow down what the XRP network value could be. So model results, and I'll go through this relatively quickly. If anybody has any questions, definitely please feel free to shoot us an email, reach out. We're always refining this process. We're always looking for ways to improve it, and we really want to kind of lay the groundwork for how we can start thinking about, like I mentioned, these types of crypto assets. So if we start at this top line, these total global cross-border payments, I mentioned we grow those to about 230 trillion in 2028, and that's based on this McKinsey report, and we've cited that below. The really important part about this is looking at the difference between what the average fee per payment is in the current system, and then comparing that to what these cost savings would be using Ripple, which again were alluded to earlier, and then on top of that, what the fees saved by using XRP over other Ripple products. And that's really where we kind of drive this incremental value over time, and that's what we discount back. And you can see below, this is actually directly from some of the Ripple reports and the Ripple insights we were able to gather. Again, really, really helpful things that they've put out in terms of understanding what the current system looks like, what the benefits of using Ripple are, and then what the incremental benefit would be to use XRP on top of that over time. So this is forecasting out what Ripple's market share would be. So this is, again, Ripple the company, how many, what kind of piece of that pie, that global cross-border payment pie that they'd be able to get their hands on over the next 10 years. We also forecast out, so the fees, assuming these Ripple fees per transaction and the XRP per transaction, this is how we get to that value of savings and kind of a notional value using XRP over time. And then velocity. So this is, yep, go ahead.
Now, Kevin, I was just wondering, obviously the 79% market share in the terminal years, they're obviously effectively owning the market. So I'm just trying to understand kind of what, how you got to that, to that market share.
Yeah, no, it's a great question. So we used a pretty typical standard S-curve adoption curve. We actually steepened it a little bit because what we wanted to see was we wanted to make this. We think that's pretty generous, obviously, but we wanted to see, could we really make kind of the use case for the current valuation, or what XRP's current valuation is in the marketplace. And as you'll see, based on what we think for velocity increasing, as again XRP becomes more popular. So it's that double-edged sword of XRP continues to be used and will gain adoption because you can really have these not only cost savings, but the settlement times are faster and all the things that Cory alluded to. But when it comes to the actual number or the network value that's going to be needed or that's going to accrue to XRP, we really think that the velocity aspect is going to kind of have that dampening effect because you can transact in XRP extremely fungible. You can transact extremely quickly with XRP based on the technology, the underlying technology that it's built upon. So to answer your long answer to your question is we thought that was pretty generous as well. 80%, 10 years out, basically assumed to capture most of this market. But what was really interesting is that even at those rates, the value we were able to calculate for what the potential long-term network value of XRP would be was significantly less than what it's trading for today. Again, nothing's to be taken in isolation. This is based on just total global cross-border payments, which is a very big pie, but it's not the whole pie. So again, it was just kind of laying the framework for how you can start to think about trying to value things like this from an investor standpoint.
And when you're looking at velocity, are you assuming that all the coins at this point are in circulation? Do you make any assumptions for hodling, and if that has any impact on value?
Yeah, so right now this uses what would be in circulating supply, not necessarily the total supply, the 100 billion that was, and everything that's locked up in escrow. There will be, and we can make adjustments for the amount that we believe would be held. And one of the when we say improvements, and I'll get to this in a couple slides, we have a couple suggestions or improvements from a pure, again, XRP valuation standpoint that we think would help the long-term use or the long-term argument to hold on to XRP. But right now there aren't a ton of, you're not a financial institution, not a ton of benefits to doing that, or at least we don't see so. So again, the long answer to your question, right now it assumes a pretty generous velocity rate going through the next 10 years. We think that velocity rate could actually be even higher. And as you'll see, I mean, the network valuation, even if we locked up, let's say half the circulating supply, it still would be pretty significantly less than what we're seeing today in terms of an XRP price. So this next one really just kind of brings it all together. Again, we discount this back at a 40% discount rate. And again, please reach out to us. We don't want to bore you with all the numbers here. But again, it really should serve as just kind of like a framework for starting to think about these things. Really excited to hear thoughts or questions on this. But one kind of the key takeaways that we have here, and I mentioned potential improvements, we have that in quotes because again, Ripple, the company itself, very different than XRP, as was alluded to earlier. And so these improvements are more so what we think could help drive value at a token level to XRP. But maybe it's not necessarily the best thing or in the best interest of Ripple, the company themselves. So key takeaways, again, owning XRP does entitle you to cash flow distributions from Ripple. So this is why our model really focuses on the long-term value of more the XRP network. Transaction speed is definitely an advantage and can entice financial institutions to leverage Ripple solutions. But the increase in that expected velocity of XRP, we think really could serve as a pretty big headwind to the long-term value proposition for it. And again, intended to serve as a proxy given the methods to determine network potential and really the valuation methods in the space right now are still really in their infancy. So the potential improvements, again, incorporating XRP into more of their product offerings. XRP could also accrue more value potentially by capturing the gap between the current system fees and Ripple's cheaper alternatives. So what I mean by that is, we've got an actual kind of more bullish case or bull case here, the revised Ripple results, which basically looks at the average fee per payment in the current system, right? So that hasn't changed. the XRP fee per transaction, assuming it captures all of that incremental value. So if we go back really quickly to this slide right here, you can see that in the bottom left, that 20.9, the 14.1 for using Ripple, and the 12 basis points Ripple plus XRP. This new kind of revised case assumes it captures that entire, almost 9-10 basis points for the Ripple XRP versus the current system. And even then, when we run those numbers, the MPV, the valuation still is significantly less than what we see today. Again, this is more so just trying to put a framework around how you can understand the value of these things, or try to understand the value of these things, because this is a very unique and new space, and valuing networks rather than actually valuing what Ripple the company would be are two very, very different things. Now, on the flip side, again, price maybe long-term doesn't necessarily, long-term we think price will converge to who the long-term value is. But again, Cory made some great points. In terms of portfolio diversification right now, if you look at, this is looking at Bitcoin versus Ether, 90-day correlations, and you see it's relatively high for the most part, and really has picked up recently with the most recent sell-off in the market. But if you look at XRP versus Bitcoin, or if you look at XRP versus Ether, you can see that the correlations have actually broken down pretty significantly. Part of the reason could be that there have been some announcements out of Ripple, and it is a real product that is being used, versus the rest of the market, which really has seen a pretty drastic sell-off. So there are potential portfolio diversification benefits to XRP. Finally, just some key risks. I'll save some time for questions because I know we're running short here. Regulatory risk, validator centralization, that's kind of been addressed earlier. Competition from other potential blockchain platforms like Stellar, Swift GPI, which is already an established legacy system. JP Morgan had an announcement this morning about targeting interbank payments. So there's a number of different players that are kind of vying for this spot. And then the volatility, right? But what we can see is that volatility, for the most part, has come down across the market. That's looking at the Ripple volatility on the bottom there, the historical 30-day volatility. It's continued to come down, but we would want to see that come down even further, just so, again, it doesn't discourage banks or financial institutions from holding this. So with that being said, I will kick it back to you, Lou.
Okay, well, terrific, Kevin. Thanks a lot for that. And just real quick, one question we had from the audience that is about the 40% discount rate. Kind of where you came up with that?
Yeah, so we use that. We kind of based ours off on traditional, kind of VC type investments. Again, you could argue for higher or lower. I mean, the argument for higher would be this is very experimental technology. There is, again, the regulatory risk. I won't, kind of pick sides here. What they were talking about earlier about XRP potentially being a rule of security, things like that kind of factored into our higher discount rate. Because again, with this technology being so new, the most bearish case for any of these, crypto assets is that they end up going to zero, or something happens in which it really hampers their long-term value. So that's kind of the reason why we used 40% as our base discount rate.
Okay. So again, unfortunately, we're running out of time. What I'd like to do, and we have a few more questions we might be able to get to, but real quick is, I'd like to give Nick just a couple minutes, because I know Cory commented on Nick's comments. If Nick had any comments on what Cory said, and then I want to leave Cory the opportunity both to respond to Nick and to see if also, since Cory was kind enough to join us here on the call, to see if he had any thoughts on anything that Kevin said as well. So Nick, did you want to add anything to what you had said before, kind of post Cory's comments?
Sure. I'll jump in quickly here. So by the way, first of all, thank you again, everybody, for being on. Cory, thank you for your thoughts. I find them very helpful. A couple of things that I want to address. The first one is just the question of, oh, well, I don't know if the SEC, would take kindly to the idea that they don't make a determination of whether or not something is security, and that, courts don't read the Howey test literally. I think both of those things are fairly well established. You can find all sorts of case law precedent, including in Foreman, all the leading Supreme Court cases, Foreman, Glenn W. Turner, SEC versus SG Ltd., all of which dive into the details here and sort of broadly articulate what I discussed earlier, including, reading out the word solely, reading in different things and determining whether or not something is an investment contract. et cetera, et cetera. On the other thing that I wanted to address is just sort of this decentralization point. So obviously Cory is in a much better position than I am to know, how many validators are out there, how many folks are actually verifying transactions on their network. The only thing that I would caution here, and again, this goes back to SEC not being the sole sort of arbiter of regulation in this space, is that, any offer or sale of securities must either be registered or exempt. So, I think Hinman in his statement specifically carved out Ether and Bitcoin, saying that they weren't securities, but again, he accepted the initial issuance of those securities. In a world with Ripple and XRP, where it seems like, when XRP was initially offered to retail investors, there was this sort of centralized control, and assuming that the way that Cory states it in terms of, having 5% of control over the corporation, again, we're talking about a line drawing exercise here. It seems to me that you would not only have to now be decentralized in order to fully escape these sort of class action lawsuits that are going to come from investors, but would have had to have been decentralized when you initially issued the tokens. I actually saw another question that I'm just going to address quickly, and then I'll hand it back off to Cory. Someone asked, what is Ripple's next move? Should XRP get classified as a security? Where does that leave the company and XRP investors? So it's a really interesting question. Obviously my background is as a lawyer and as an investment banker, and therefore I tend to take a more conservative view on things. In the event that XRP gets classified as a security, in order to comply with securities laws, you have to register or find an applicable exemption from registration. If you're an investor, depending on when you bought in, you may have, the ability to go and claim a financial right against the company or whatever fund they set up to actually to pay a settlement. That being said, I don't think that any of this, it's very rare, I should say, in legal circles that any of these things actually get to a final judicial resolution, because as things progress, folks will be more incented to settle or sort of back away. Anyways, I'll stop there. I know that Cory, I'm sure, has some things he wants to get out, both in response to me and to Kevin.
Okay, thanks, Dick. And Cory, we're giving you the last word here.
Oh yeah, sure. And I'm not in a big rush. I changed my flight here, so but I know we got to get off the call eventually. So Nick, I appreciate that, and I think we're all in agreement. Who knows who's going to decide what? We don't. My expectation is, if anything, it would be decided, probably would be the SEC making that kind of statement, or not. I just, I don't know how to predict what they're going to do here. But it's pretty clear to us that because we didn't offer XRP off, it wasn't like the ICOs that happened with other companies and things. It's just a different beast. And I think that regulatory bodies all over the world are going to have to figure out what to make of these digital assets, because they're not securities, and they're not commodities, and they're not physical property, and it really is a new kind of beast. And eventually it's going to have its own designation, I would suspect, because it really is a different kind of thing here. And it's also clear that the SEC has gone after bad actors who are clearly trying to skirt securities law with the issuance of coins that represent fractional ownership in the enterprise, and that's been a big focus of the SEC. And so we'll see what happens there. I want to get to what Kevin was talking about, volatility, and I think it's a really interesting notion to try to imagine what demand would look like, and what consistent demand in massive volume would look like for XRP globally. I'm envious of his work and can't wait to dig into those numbers a little bit more. But I think that fundamentally, what this notion of volatility, if you're long pesos, if you're long dollars, if you're long Turkish lira, if you're long rubles, those tend to be fairly stable currencies until they're not. But the duration that businesses and banks hold these things are typically 3 to 5 days, because that's how long the transactions take. So you're long these things that are not that volatile until the day that they are volatile. In the case of using XRP for a cross-border transaction, you're long that XRP for 3 to 5 seconds. So the actual volatility that you're exposed to is de minimis, because the speed of the transaction is so fast. So the traditional notion of currency risk and volatility risk is really turned on its head when we're in a digital age, which we're just not used to being with value, because the technology is so crappy. But I think that we've shown with Ripple it's a very different world where you're long the currency for seconds. But that also plays into that sort of discounted cash flow notion of what is it? What is demand? How does demand affect price when the demand happens in seconds, not days? And I don't know that any of us has an answer to that. Does that make sense?
Yeah, no, it's a good point, and yeah, I think you're right. Nobody does know the
It's
answer to these
mind-boggling.
things
It's
yet.
really cool, but it's mind-boggling.
Undoubtedly. Okay, well, terrific, Cory. Thanks a lot for those answers, and Nick and Kevin, thanks a lot for participating. You know, both of you had great content. Thanks for everybody for dialing in or linking in, and we'll see everybody later.
Yeah, thank you all. Appreciate it.
Hey, guys.
Thank you, everybody.